The secrets to emotion-free trading. How to consistently act in your own best interest with your off-the-floor trading. The tale of two traders. Our first trader is Ned. Ned is an off-the-floor trader who day trades the S&P 500 futures. He's been trying to be consistently successful for the last 6 months. Unfortunately, it hasn't worked out very well. But it's not because of his methods that he's having so much trouble. No, the main reason Ned is not making the kind of money he wants is because he cannot control his emotions and consistently act in his own best interest. From the very beginning, Ned was confident he would be successful day trading the S&Ps. He'd been very successful in his previous business. Ned owned a retail printing company, and he'd learned to make good sound business decisions that helped him become very successful. He almost never made any major mistakes that were detrimental to the business. In fact, in over the 9 years he owned the company, he really prided himself in always looking at the big picture and keeping his business moving forward. On the rare occasion when something did go wrong, Ned worked at lightning speed to fix the problem, and many times he turned the crisis into an opportunity. Because of the smart decisions he'd often made, Ned was sure he could carry this into his new career of commodity trading. At least that's what he thought would happen. So when Ned received a generous offer from a corporation to buy his printing company, he decided this might be the time to take the money and run. It wasn't that difficult for him to decide to sell. He definitely loved having his own business, and, of course, it was that much more rewarding because he was successful. But for the last 2 years, he'd been so busy that he was working about 65 to 70 hours a week. That left very little time for him to spend with his family. This made the decision to sell very easy for him. Another thing that made Ned's decision easy was that he wanted to try a new business. He had learned as much as he could about commodity trading. He'd read as many books and magazines he could get his hands on. He definitely thought he could transfer his successful business practices to commodity trading. Thus, he could trade from home and be able to spend a lot more time with his family. He was quite confident he would be a success in this endeavor too. Boy, was he in for a surprise. The second trader in our story is James. James also wanted to day trade the S&P 500 futures. His background is a little different than Ned's. James has spent the last 4 years working at the Chicago Mercantile Exchange, where the S&P 500 futures are traded. But James was not a trader at the CME. He had basically worked his way up from a runner. He was working for a retail commodity firm as a phone clerk. His job was to put in buy and sell orders for customers using hand signals. From the first day James had started working at the exchange, he had always wanted to be a trader. He knew he didn't have enough money to buy a seat on the exchange, which costs about $200,000. He thought his best chance to become a trader was to learn all he could from the various floor traders and other people on the trading floor, and then trade from off the floor, where he wouldn't have to own a seat. James spent as much time as possible trying to learn how people in the commodity business made money. He was sure there had to be some very specific techniques only the real successful people were using. He certainly knew, like everybody else, that 80 to 90% of the people lost money trading. He was determined to learn what he needed to know so he could be successful when he started trading from off the floor. He wanted to start trading as soon as possible. James made a point of trying to meet as many successful traders, both on and off the floor, as he could. He was lucky enough to be exposed to all these successful people on the floor and in the various offices at the Chicago Mercantile Exchange. He thought if he could figure out exactly what the successful traders were doing, he could model his own trading off of them. He spent every free moment talking to the various traders that he'd met and tried to find out the Secrets of their success. He learned a lot. He learned all kinds of different technical methods that the various floor traders and off-the-floor traders used. James had never traded a futures contract in his life. But the more he talked to different traders, the more his confidence grew. He was sure with the experience he was getting he would surely be a successful off-the-floor trader. But he still needed one more important lesson. Ned began trading. He started with $15,000 in his account and decided he would only trade one contract at a time until he was sure he had the hang of things. Things actually started off fairly well for Ned. His first trade made 320 points, $800 before commission charges. Obviously, Ned felt very good about his start. Unfortunately, things went downhill from there. On his next 4 trades, he lost on all 4. The problem was that Ned had good profits on 2 of those 4 trades, but he failed to take them because he would look for a lot more than the market was offering. So, in his first week, instead of making a small profit or breaking even with the 4 trades, he ended up losing the original $800 and even another $1,200 more. This was very frustrating and confusing to Ned. He obviously needed to do a lot better if he was going to be successful in this business. But not to worry, it was only the first week. He certainly didn't make a fortune his first week in the printing business. The next week started basically the same as the first. His first trade on Monday was another nice winner of 280 points, $700, but the downhill slide started again. Ned did his next trade on Tuesday of that week. He got in and the market went his way about 120 points. Ned knew if he could make 200 points on this trade, he could get back to even. So that is what he decided to look for in this trade. He put an order to get him out of the market with a 200-point profit. The problem is the market only went 150 points his way, and Ned did not trail his stop order to lock in a profit, or at least move his stop to break even. He really wanted to get that 200-point profit so he could be even, but the market came all the way back and not only took away the 150 points in profit it was offering, but also took away the amount he was originally risking when the market hit his stop order. Ned ended up losing $400 on this trade. Now Ned was very frustrated. Sitting at his desk, he considered throwing his empty ceramic coffee cup across the room at the wall. Luckily, he resisted doing this as the thought of getting the broom and dustpan to pick up broken glass didn't seem like it would fix his losing trades. Nevertheless, Ned was extremely frustrated and needed to come up with a way to fix things. One of the most important things you can do is to set a daily, weekly, and monthly goal for yourself. James was getting some advice from one of the most successful off-the-floor traders he knew. This particular off-the-floor trader had made over $500,000 a year for the last 4 years, so James knew he was getting good advice. The way to be successful is to have measurable goals for yourself, the off-the-floor trader continued, and then you have to continually visualize yourself reaching those goals. James understood about setting goals, but he really wasn't sure what the visualization part meant. He knew he would need to find out what that was all about. James continued to talk to as many successful traders as he could. They all seemed to say the same things. Goal setting was extremely important. Just trying to make money each day without a goal was a road to failure. It seemed like almost every trader James talked with really stressed the daily goal setting idea. In fact, it seemed the more successful the trader, the more they stressed goal setting. James made a strong mental note that if he were to be successful, he would need to have very specific goals as to how much he wanted to make each day, as well as how much he was willing to lose. James found another fairly successful floor trader named Bob. Bob was nice enough to give James some advice. Yes, I agree with you. you do need to set introduction. Acting in your own best interest. You will see this theme throughout this book. It is the most important concept you can learn in order to be a successful trader. If you can master this skill, you can be very successful in this business. But without it, you are destined to fail. It really is that simple. If you can learn to act in your own best interest, you will make a lot of money trading. If you don't learn to act in your own best interest, you will lose a lot of money trading. You see, the futures markets work in a very different way than almost everything else in life. There is more freedom in this business than probably any other business in the world. You can do what you want, when you want, pretty much any time the market is open. The only thing that will hold you back is running out of money. Other than that, you have all the freedom in the world to do whatever you want in the market. Trading really is different from everything else we do in life. In the everyday environment, you can have control, at least somewhat, by taking actions that affect the environment. For example, if you wanted to listen to some music, you would have to turn on the radio. If you push the power button on the radio, music will come out of the radio. If you don't push the power button, the radio will not turn on. Another example would be if you wanted to start your car. If you put the key in the ignition and turn it, the car will most likely start because you did something to affect the change. If you don't turn the key, the car will not start. You must change the environment by turning the key to get the car to start. Every day we all do things to affect changes on the environment. We put our bank card in the money machine to get cash out. We push the button on the coffee maker to make coffee come out in the morning. These are all changes that we can consciously make happen. But here's the difference. In trading, you can't control what the market will do. No matter how much you want the market to go in a certain direction, there is nothing you can do to make it go in that direction. There is no effect that you can cause on the market to make it do what you want it to do. We can't push a button, we can't turn a key, nothing we do will make the market do what we want it to. Nothing at all. So, if we can't control the market and what it will do, then the only thing that will make us successful is if we can control ourselves. And that's easier said than done. But it is the reality of successful trading. Again, you can't control what the market will do, so you must control what you will do. I've met hundreds and hundreds of traders and, unfortunately, many of them fail at trading. Most never learn the proper skills they need to be successful. Most of them focus so hard on finding the perfect technical method or mechanical system, and very few people realize that is much less than half the battle. A person with good self-discipline, but a poor trading method will outperform a person with poor self-discipline, but the best trading method currently available. Being able to act in your own best interest is much more important than finding the perfect technical method. As I often say, a person with good self-discipline, but a poor trading method will outperform a person with poor self-discipline, but the best trading method currently available. It will work like this every time. Quite frequently, I talk to people who've had very large profits in certain trades. For example, I remember a time when a person called me and told me he had 800 points in a 3-lot trade in the sand peas, worth approximately $6,000. But even with that big profit, this particular trader still lost money on the trade. When I asked why he didn't trail his protective stop order to lock in some profit, he told me he was looking for the big home run. Right then I knew this person didn't have his best interest in mind. Sure, we all want those huge winning trades. But one thing we must all remember is we can't control what the market will do, so we must be prepared for whatever it does do. Thus, a person who gets 800 points in an S&P trade, not an easy thing to do, must have his best interest in mind and not allow all of that profit to evaporate. even if that means missing out on the big winner. This book is broken up into 3 sections. The first section is called Skills You Do Need and is made up of all the skills I believe you must have to be successful in the trading environment. These include ideas like setting and accomplishing goals, being an active winner and loser, flawless execution of your trades, etc. The second section is called Skills You Don't Need. Included in this section are chapters on wishing, hoping, and praying. Also included is a chapter called Revenge Trading. Another chapter is called Emotions, Fear, Anger, and Greed. This section will help you to know the things you must stay away from to become successful with your trading. The third and final section is made up of ideas originally put together many years ago by the famed Dr. Maxwell Maltz, who coined the term Psycho-Cybernetics. This section is called How to Improve Yourself. The chapters in this section will give you background on how Psycho-Cybernetics works and how you can use it to greatly improve your trading results. This section contains the most important part of this book, step-by-step exercises to teach you how to act in your own best interest and deal best with the emotional side of trading. These exercises are all based on the works of Dr. Maxwell Maltz and Psycho-Cybernetics. Section 1. Skills You Do Need. Chapter 1. Setting and Accomplishing Realistic Goals. I realized early on in my trading career that one of the most common characteristics in almost all successful traders I'd met was they are all very goal-oriented. In fact, I'm not sure if you realize it or not, but that's when people are at their best. People perform at their best when they have a goal clearly in their mind. That is the way the human mind works. When we have a goal clearly in our minds, our subconscious works very hard at helping us to achieve that goal. It does it quite automatically without having to fight. Using willpower. This is something you'll learn much more about when you start learning more about Psycho-Cybernetics. But there is one big catch. You may have a goal clearly in mind, but it must have 3 important characteristics. 1. Your goal must be realistic. 2. Your goal must be attainable. 3. Your goal must be measurable. Your goal must be realistic. This means that your goal has to be something that is within your capabilities. Sure, it may be possible to make $1 million your first year trading, but it's probably not very realistic because it isn't within your capabilities yet. Your goal must be attainable. This is similar to a goal being realistic. Again, your goal must be within your capabilities. So, an example might be if you are trying to average $250, $500 a day with your trading from off the floor. You have a much better chance of being able to reach the goal versus the goal to make $1 million this year. Don't get me wrong, if you are doing very well with your current goal, there's no reason you can't raise it somewhat. But you must start with a goal that is attainable, and then you can build on it. I highly suggest starting with a small goal and moving up from there. Your goal must be measurable. This is one I see people making a mistake about all the time. Everybody wants to get rich or make a fortune in the market. That seems to be everybody's goal. But you know what? That isn't really a goal. A goal must be measurable. You must be able to know when you're far away, close, and when you've achieved your particular goal. If it's not measurable, you won't know when you're there, and even worse, you won't know how close you are to reaching your goal. When I first started working on the trading floor, I spent lots of time talking to different traders about how they were able to make money in the markets. It seemed like the more I talked to different traders, the more their answers all sounded the same. Realistic, measurable. Goal setting is extremely important to being successful in trading. In fact, just trying to make money each day without a goal is a road to failure. The more successful the trader I talked to, the more they would stress how important setting goals was to their success. But you even need to take it a step further. Not only do you Need realistic, measurable goals. Chapter 2. Learning to love to take a loss. This is something you'll hear successful floor traders say all the time. If you're going to be a successful trader, either on or off the floor, you will have to learn to love taking a loss. Basically, what that means is it does not bother you to have a losing trade. Don't get me wrong, you're not going to be happy to have a losing trade, but you should be happy to be out of the market when the trade no longer represents a profitable opportunity. Most people who learn this do it the hard way. They end up losing all their money before they realize how important it is to love taking a loss. Instead of ignoring the fact that they have a losing trade, like most people do, successful traders confront the possibility of being wrong, and thus, when the time comes to take a loss, they do it without hesitation. Your losing trades do not diminish you as a person. You are not your losing trades. You are also not winning your trades either. They are simply byproducts of the business that you're in. I think the reason that so many people have trouble getting out of their losing trades is because they think the losing trade is a reflection of themselves. Nothing could be further from the truth. Your losing trades do not diminish you as a person. You are not your losing trades. You are also not your winning trades either. They are simply byproducts of the business that you're in. Losing trades are part of trading. The most successful traders in the world have losing trades each and every day. They do not get caught up in thinking that the losing trade is part of them. They realize it's just part of trading, and the sooner they get rid of the losing trade, the faster they can look for the next opportunity to find a winning trade. This is easier said than done, but nevertheless, it's still the reality of how to make money trading. I have a friend who's been an S&P floor trader for over 15 years. He is probably one of the 5 best traders in the S&P pit. He's also probably one of the 25 best floor traders in the world. The house he lives in has 14 bedrooms and a 6-car garage. So obviously, he does pretty well with his trading. He has literally thousands and thousands of dollars in losing trades almost each day. He probably has more money in losing trades each day than most people make in a month. Obviously, he has many thousands of dollars in winning trades also. The point is he has learned to realize that having losing trades is part of the game, and he knows the quicker he can get rid of the losing trades, the sooner he can find some winning trades. It will be the same for you, but only on a smaller scale. One thing you'll need to learn is why it's so important to confront the possibility of a losing trade. If you don't, you will generate fear and end up with the very situation you are trying to avoid. When you can learn to understand this concept, only then can you prevent your losing trades from becoming unmanageable and, quite possibly, from wiping out your entire account. Mark Douglas, author of The Disciplined Trader, states, "Execute your losing trades immediately upon perception that they exist. When losses are predefined and executed without hesitation, there is nothing to consider, weigh, or judge, and consequently nothing to tempt yourself with. There will be no threat of allowing yourself the possibility of ultimate disaster. If you find yourself considering, weighing, or judging, then you are either not predefining what a loss is or you are not executing them immediately upon perception, in which case, if you don't, and it turns out to be profitable, you are reinforcing an inappropriate behavior that will inevitably lead to disaster. Or if you don't and the loss worsens, you will create a negative cycle of pain that once started will be difficult to stop." He goes on to say, "Keep in mind that fear is really the only thing that keeps us from learning anything new. You can't learn anything new about the nature of the market's behavior if you are afraid of what you may do or can't do that is not in your best interests. By predefining and cutting your losses short, you are making yourself available to learn the best possible way to let your profits grow. If you can change what these losses mean to you and realize that getting out of a losing Trade as soon as you define it as such. You will be able to release yourself from the stress that those losing trades probably cause you now. This is why learning to love taking a loss is so important. It puts you in a much better position to take the winning trades. Chapter 3. Time has no bearing on money. Most of us have ideas about the amount of time it takes to make a certain amount of money. These ideas do not apply to trading the markets. A trader can literally make thousands of dollars in a matter of minutes or even seconds with very little effort expended at all. This is very different than what most people are brought up to believe is possible about making money. Most people are raised to believe that to make money, especially large sums of money, it takes much time and effort. When I first started trading, my family and friends couldn't understand how, in just a matter of minutes, I could have the possibility of being up or down many thousands of dollars. People don't make thousands of dollars in minutes. It takes weeks. At least it does in most businesses. To many people, the possibility to make or lose money that quickly is something they'll never experience. But to a trader, this is something we experience on a daily basis. To be a successful trader, you'll definitely need to get used to it. The problem is many people have a mental conflict with that kind of situation. Because of our upbringing, we have certain beliefs about whether we deserve to make money that quickly. In many cases, we are so taken back that we made that much money so fast that it doesn't seem to be right that we could have that much that quickly. This leads to two serious problems. The first problem is the big one. If you subconsciously don't feel you deserve to make money so quickly, then when we do get that quick windfall, our subconscious will say, "Hey, you can't make money that fast. We'd better find a way to give that money back." And believe it or not, you will most likely end up doing just that. That is how powerful your subconscious is. If you have a certain belief about yourself, your subconscious will strive to make that belief true. For instance, if you do make a large profit very quickly, you will find a way to give that money back, because inside you it doesn't feel right. It might feel great and exciting to have made so much so quickly, but deep inside, in your subconscious, it is not right at all. And your super powerful subconscious will override your conscious thoughts and find a way to give back that money you didn't feel you deserved in the first place. In Section 3, we will talk about an exercise to become comfortable with large windfalls. You'll learn how to be deserving of those windfalls, so your subconscious does not try and force you to give the money back. The second problem with this mental conflict is it causes people to stay in trades way too long. Here's what happens. A person gets into a trade, and for whatever reason it goes their way right away. They make those thousands of dollars we just talked about in only a few minutes. This is great, but the problem comes up when they feel the trade must be worth much, much more. They feel this way because it moved their way so quickly that the market just has to keep moving in this direction. Well, we all know the market doesn't have to do anything. It only does what the buy and sell orders cause it to do. I see this situation all the time. One of the most important things you must realize about trading is that the market can take away profits just as easily as it can give them, and just as quickly. Because of this fact, you must protect your trading. Of course, that means you should be trailing your stop orders to lock in profits. But it also means you need to protect yourself mentally. Just because the market gave you $1,000 in profit in 2 minutes, it has nothing whatsoever to do with whether the market is going to continue in the same direction. Nothing whatsoever. But a lot of people get caught up in thinking that it does. That is a big mistake. For instance, let's say you get short the S&P 500 futures. Right after you get short, a huge sell order comes in to sell 2,000 contracts at the market. This particular order drops the market like a rock. After that order is filled, you are sitting on a $2,500 profit in a matter of less than a minute. You are sure that after falling that much that quickly the market must be completely ready to fall. Chapter 6. Trading Rules. It's kind of strange in a world with no rules, like trading, that it's so important to have a specific set of rules that you follow religiously. I mean, let's be honest, trading really doesn't have any rules. You can get in whenever you want. You can get out whenever you want. You can add and subtract to your existing position, and you can obviously decide simply not to trade. The only thing that could prevent you from participating is the lack of required money to trade. Other than that, you get to decide what you want to do and when you want to do it. There are not too many other businesses that allow for that much freedom. Because there really aren't any set rules, you'll need to make your own. Otherwise, you'll most likely be overwhelmed with all the different possibilities in the market. If you decide to trade without any rules, I promise you will not be successful. Freedom is good, but you need to have what I call a structured freedom. Basically, that means you should be able to trade when you want to, but the trades you do need to fall under your set rules. Rules will help you be more consistent with your trading. They'll help you avoid mental mistakes that can drain your account. About once every 6 months, I write a new set of trading rules for myself. These rules help me to be structured with my trading. And you know, it's the strangest thing, when I have a bad day, it's because I didn't follow one or more of my rules. And of course, the opposite is usually true. If I've had a good day trading, it's because I did follow my rules. No matter what type of trading you're doing, swing trading, day trading, long-term trading, you'll need to come up with your own set of rules to keep your trading structured. The problem is most people don't want to make up their own rules, because if they did, they would have to take responsibility for their results. And, as we all know, most people don't want to take responsibility for their action. But, as we all know, the only way to be successful in trading is to take 100% responsibility and act in our own best interest. For those that don't know, I day trade the S&P 500 futures almost exclusively. I updated my rules in July of 1998. I thought it might help you to see what my rules look like, and I'll try to give an explanation of each rule as it applies to my trading. These are exactly how my rules look taped up to the side of my computer in my office. Rules for trading July 6, 98. 1. Always use a stop order. I never put on a trade without a stop order. 2. After 3 losing trades in one day, stop trading. I want to avoid digging myself in a huge hole. 3. If I get 100 points plus profit in a trade, I will move my stop to break even. If I get decent money in a trade, I will not allow myself to lose money on that trade. 4. Only use a signal to get into the market. Don't just take a shot. I usually get myself in trouble if I have a feeling about the market and act on it. I'm much more successful when I use a chart formation or a technical reason to get into the market. 5. Use the secrets of floor traders rules. They work. This is the course I put together for day trading the S&Ps. It includes all the techniques that I use to trade. 6. Do not trade on holiday type volume. Too slow, bad opportunities. Go outside. Watch a movie, whatever. In almost every case, when I trade in these types of markets, my winning trades are much smaller, and my losers are much bigger. It's not worth it. 7. Always act with your best interest in mind. This is something I try and do with each and every trade I put on. I realize that only I'm responsible for my results. 8. Consistently trade on long side above value and the short side below value. I use the value area to help stay on the right side of the market. 9. Always look for single ticks to help you execute your trades. This is a market profile technique that I use to help me find support and resistance areas. 10. Relax with your trades. If it's not fun and enjoyable, it's not worth doing. This is self-explanatory. If you don't enjoy it, you won't be successful. 11. You don't have to trade every day. Sometimes, I'll just leave the market alone and forget about it for a day. It usually refreshes me. 12. Waiting till the market shows you whether it is one-time framing or not is an excellent way to be patient waiting to find an opportunity to trade. One-time framing is a trend-following technique that I watch for constantly. Those are the exact rules that I use each and every day, and it's almost automatic. After a bad day trading, I will look at my rules and see that I did not follow them like I should have. And again, the opposite is true. After a good day, I'll look at them and see that I followed them very well. I really believe my ability to follow those exact rules is a direct reflection of how much money I will make with my trading. The more I follow them, the better I trade. I'm quite sure the same thing will happen for you. Although I would say you'll want to come up with your own set of rules. You can certainly use mine as a guide, but the important thing is you must be comfortable with the rules you come up with. I know that I'm very comfortable with my rules. You'll need to do that with your rules. If you're not comfortable, they will be very difficult for you to follow, and the odds of you being profitable will be very low. One thing that is common in trading is the temptation to not follow your rules just this one time. This comes from the very real possibility of the exciting results that are possible. This is the trap that many new traders, and some experienced ones too, fall into. This trap is easy to fall into because many people have a terrible fear of missing out on a big move. A good example would be when you see the Dow Jones up 250 points, and you feel as though you must find a way to get long the S&P market even if it breaks many of your rules to do so. Avoid at all costs getting caught in that trap. Doing a trade because you're afraid of missing out on a big move is not acting in your best interest. Avoid at all costs getting caught in that trap. Doing a trade because you're afraid of missing out on a big move is not acting in your best interest. I've got news for you. There are big moves almost every day. Besides, most people do not think about missing those big moves in a realistic way. When you've missed an opportunity, you have a tendency to think about it unrealistically. You see the bottom and the top of the big move and think to yourself that you would have been able to capture the entire move. I think we all know that isn't likely to happen. But our mind plays tricks on us and says we shouldn't have missed out. Again, the market doesn't stop moving. If you weren't able to get into the previous opportunity, look for the next one. Don't let your mind play tricks on you. The more you follow your rules, the more you'll trust yourself and the better your results will be. Remember, only you are responsible for your trading results, good or bad. Having a set of rules will help you get more good than bad. Chapter 7. Flawless Execution. Many people get confused and think that flawless execution means always selling near the high and buying near the low. It doesn't mean that at all. No, in fact, I think it will be very rare in almost all of your trades for you to buy near the low and sell near the high. You don't need to buy the low and sell the high to make money in this business. What flawless execution means is acting on an opportunity, either getting in or out of a trade, the moment you see that it's an opportunity without hesitation. Unfortunately, this is a lot easier said than done. But that doesn't mean you can't learn to do it. There are many good technical methods and mechanical systems out there. Even still, many people using these proven methods and systems still end up losing money. The reason is very simple: lack of flawless execution. Again, flawless execution does not mean having the perfect trade. It means being able to act immediately on the opportunities that you see in the market. Most people think of themselves as risk takers, but what they really want is a guaranteed outcome. But there is a conflict. You can't be a risk taker and still get guaranteed outcomes. They just don't work together. And that is just the reason that many people hesitate when it comes time to Chapter 8. The use of stop orders. I think any trader, no matter how good their discipline is, should be using stop orders. In all my years, I've never met a successful off-the-floor trader who didn't use stop orders. It will definitely help you act in your own best interest more often than not. Whenever I initiate a position from off the floor, I always make sure I have a stop order. And to protect myself, I highly suggest all off-the-floor traders also use stop orders to protect themselves and their open positions. I can't tell you how many times I've spoken to off-the-floor traders who failed to use a stop order and then lost 20 to 25% of their account in a single trade, with only one contract in the S&P 500 futures. The more you trade, the more you realize what a big part emotional discipline plays in your trading. Like I've said before, being successful really has more to do with acting in your own best interest than it does the technical method or system you're using, which is precisely the reason using stop orders will be so important to your trading. It really surprises me when I hear people say, "I hate using stop orders." Stop orders are the off-the-floor trader's best friend. As we talked about earlier, protecting yourself and acting in your own best interest is the only way to be profitable. Using stop orders to protect your trades allows you to be a little less emotionally involved in your trades. And as we know, the more you let your emotions get the best of you, the less likely you are to make money. Some people don't want to use stop orders when trading. For some strange reason, they get caught up in thinking that the market will hit their stop order and then immediately start moving in their direction after they're stopped out. And you know what? This will happen sometimes for people who attempt to use mental stops, where they'll just call and get themselves out of the market instead of putting the stop order in the market. The problem comes up when the market does go through their mental stop order, then reverses and starts moving back in their direction. Usually, these people are at a loss of what to do next. And the unfortunate thing is it usually costs them a lot of money, as they do not act in their best interest. They let a losing trade turn into a huge losing trade. The biggest reason people don't want to use stop orders is because they can't or won't admit they were wrong about which way they thought the market was going. This is about the worst trade you can have. There is nothing wrong with having a manageable losing trade. The difficulty comes in when your losing trades are unmanageable. This can easily happen because you take too much risk on a particular trade by not using a protective stop order. I think these people are under the impression if they don't get out of the market by not using a stop order, they can't take a loss because the market can always come back. That idea is attractive to some because it can actually happen like that. The market can come back no matter how far it was once against you. But I'm telling you, you are asking for a disastrous situation. If you want to act in your own best interest, you will not let yourself get into a situation like that in the first place. It happens all the time. I talk to people who only planned on risking 200 points on an S&P trade. They didn't use a stop order, and because they didn't have their best interest in mind, they have a trade that is 600 to 800 points against them, and they're hoping and praying the market comes back. Hoping and praying is not acting in your own best interest. I guarantee you that. About the only way I know to be a successful off-the-floor trader is to have your stop order in place and let the floor broker get you out of the market if you're wrong. Again, small, manageable losing trades are fine. They are part of every successful trader's day. If you think you can avoid them, you're wrong. And if you think you can avoid them by not using stop orders, in my opinion, you should just save your money and not even trade. That is just my opinion, but I've been around for a while, and I've seen a lot of traders try to trade without stops. Trailing stop orders. Another way you should be acting in your own best interest is to trail your stop orders to Lock in profits in your trades. There are thousands of different ways in which to trail your stop orders as the market moves in your direction, but we won't get into all those here. The main thing I'd like you to understand is why it's so important to trail your stop orders. When you get some decent profit in your trades, you'll want to trail your stop order first, to break even, and then to hopefully lock in some profit in the trade. This is a very important thing to do. Without doing this consistently, no matter what time frame you're trading, you will not be successful. As soon as I get decent profit in a trade, I want to move my stop to break even. In other words, if I've got a few $100 profit in a S&P trade, I'll move my stop to the same price where I got in the market. Thus, if the market starts to come back and take away my profits, about the worst that will happen is I'll scratch the trade, or only lose a few ticks. But if I hadn't moved my stop to break even, then not only would the market have taken away the small profit I had, but I could also end up with a loss in the trade. One of the hardest things to deal with, emotionally, in trading is when you've had a decent profit in a trade, and then end up losing money on that trade. This can be very frustrating for an off-the-floor trader. It causes you to make dumb decisions because it is emotionally draining. This is why I think it's so important to avoid, as much as possible, getting yourself in these situations in the first place. If you can consistently trail your stops to break even once you get some decent profit in them, you will be a lot better off. You will avoid turning winning trades into losing trades, which is the biggest reason off-the-floor traders fail to be successful. Whenever I tell people about how important it is to move their stop to break even, I always get some people telling me that if they left their stop alone, they wouldn't have gotten stopped out and the market would have gone their way. Basically, they are saying that by moving their stop to break even, they got stopped out. But if they had left their stop in the original place, they wouldn't have gotten stopped out and the market would have gone their way. Do you know what I say to that? So what? That will happen sometimes. But many more times you will end up scratching the trade instead of taking a loss. And that is how you protect yourself. In this business, protecting yourself and acting in your own best interest is so much more important than taking a chance. It's not even close. I can't stress that enough. In this business, protecting yourself and acting in your own best interest is so much more important than taking a chance. It's not even close. I can't stress that enough. And remember, the same idea is true when the market continues to move in your direction. You will want to continue to trail your stop order as the market continues to move your way. Again, people are afraid of getting stopped out and then having the market continue to go in their direction. That will happen sometimes. But that is what having yourself protected is all about. You must concentrate much more energy on keeping yourself out of trouble, in other words, out of losing trades that were winning trades at one time. If you keep yourself out of the bad losing trades, the winning trades will come. Chapter 9. How to deal with the market when it never stops moving. The market is always moving. It never stops. It may slow down and pause for a little while, but it never stops moving. Even when the markets are closed, the prices are still moving, as they can certainly open up at a different price than where they closed the night before. This is more true than ever before, as many markets now trade almost 24 hours straight. The three simple ideas of getting in, getting out, and not trading become even more difficult because there really is no end. Only you can decide when to end it. In a profitable trade, you need to decide when you've made enough. Many people let greed get the best of them. These people get caught up in thinking that there is never enough, no matter how much they've made in the trade. If they've made a $500 profit, they get upset with themselves that they didn't make $1,000. If they've made $5,000, they want $6,000. A truly Greedy person can never be satisfied. No matter how much they have in a trade, it will never be. But is that the objective thing to do? No, of course not. The objective thing to do is to get out of the position and reevaluate. Or at the very least, move your stop order very close to where the market is trading to take less risk. That would be acting in your own best interest. But instead, most people ignore the information and hope and pray that the position will work out the way they think it should. This happens because most people get locked into their opinions of the market and have a lot of trouble facing the fact that they could be wrong. It's okay to be wrong about which way the market is going, but it's not okay to be wrong about the market direction and ignore signs that it's time to get out and start over. That lack of objectivity will kill your trading. To be objective, you cannot put your demands and expectations on the market. First of all, you cut yourself off or distort vital information that the market offers to help you decide which way it's going. Second of all, you don't have enough power to control the market to make it live up to your demands and expectations. Thus, you must learn to be objective in your market observations. This doesn't mean that you can't have an opinion about the market. It only means that your opinion can just as easily be wrong as it is right. And you need to be completely ready and comfortable for it to be wrong just as much as it could be right. You need to release yourself from having to be right. The more objective you are, the less you will distort the information that you receive. Mark Douglas, author of The Disciplined Trader, states there are 7 characteristics of an objective person. Here they are so you can recognize it when you've achieved it. 1. You feel no pressure to do anything. 2. You have no feeling of fear. 3. You feel no sense of rejection. 4. There is no right or wrong. 5. You recognize that this is what the market is telling me. This is what I do. 6. You can observe the market from the perspective as if you were not in a position, even where you are. 7. You are not focused on money, but on the structure of the market. If you can see any of the above qualities in yourself, you're on the right road. Again, you need to release yourself from the need to be right. If you constantly need to be right, you are, unfortunately, in the wrong business. To be a successful trader, you don't always need to be right, but you always need to be objective. Chapter 11. Being an active winner and loser. Some people believe trading is like gambling. It's not. In a gambling game, you have to participate to lose and do absolutely nothing to stop losing. If, after one bet, you don't put another bet on the table, you will not lose. There is also no way you'll win. But at that point, if you don't place another bet, there will be no risk. Obviously, in trading it's very different. You must participate to get in a trade, and you must participate, in other words, do something, to cut your losses. If you do nothing, the possibility exists that your entire account can be wiped out, and even that won't stop your losses. If you still do nothing, although, at that point, your broker will most likely participate for you by getting you out of the market. In gambling, you know exactly what your risk is, and the game always ends before the next one starts. But in trading, you don't know beforehand exactly what your risk is. You may have an idea, but even with stop orders there is always the possibility of slippage. But the real big difference between gambling and trading is the event never ends as the market keeps moving. A good example of an active winner and loser might be a person playing blackjack at a casino. You must make a conscious choice to play and risk your money. And when the game is over, the rules force you to be an active loser. If you want to play and risk your money again, you must place another bet. Without another bet, you can't be a loser again. You must actively participate to lose and do nothing to stop losing, the exact opposite of trading. This is why, in trading, being an active winner and an active loser is so important. But, because the event never ends, it's easy not to be an active winner and loser. There is always the possibility, no matter how slim, of the market coming back in any trade you're in. You don't need to actively participate to get back your losses. You could simply stay with the trade and let the market come all the way and give you back your losses. Because of this reality, there's always a constant temptation not to cut your losses. Cutting losses for many traders is painful. So many choose to avoid the pain and not be an active loser. They simply think they are at a winning trade that is yet to show profit yet. Or we will look at only the evidence that says our position is right and ignore the rest of the evidence against that notion. These are obviously traits of someone who is not an active winner and loser. But being an active loser, as well as an active winner, is the only way to be successful. Again, the temptation to not cut your losses is always there, but it will do nothing but get you in trouble. Successful traders know that cutting your losses actively, before they get too large and unmanageable, is the only way. Someone once told me, "To make money trading, you can't sit on your hands." Basically, what that means is you need to do things like getting yourself in and out of winning and losing trades to be successful. In other words, the way to make money trading is not only act in your best interest, but to actually act and do things to help your trading. That means when a trade is going against you, you really can't sit on your hands and do nothing. You must cut your losses instead of hoping the market will come back. And when a trade is going your way, you must act in your own best interest by being an active winner. Trail your stops to lock in profits. Cover your position when it reaches your target, instead of looking for a home run, etc., etc., etc. This is what being an active winner and loser is all about. Don't sit on your hands. Chapter 12. Paper Trading After a Loss. My good friend Alexander gave me this little tip a short time ago, and I think every trader can learn from it. You see, Alexander is a successful off-the-floor trader. One of the main reasons he is successful, when others are not, is because he uses some excellent techniques to keep him disciplined with his trading. I'm going to tell you about one of those excellent techniques that you can easily incorporate into your own trading. Here's the problem I see with many off-the-floor traders. Whenever they have a losing trade, whether it's a $300 losing trade or a $3,000 losing trade, they tend to want to get the money back right away, preferably in the very next trade. But what this does is put you in a very poor frame of mind. Think about it for a second. Whenever we lose something, especially money, we want it back immediately. On a subconscious level, we are almost desperate to get the money back as soon as possible. As I'm sure you realize, this kind of thinking will usually prevent you from being successful on your next trade. And then if you end up making a poor decision on your next trade, you'll have 2 losing trades in a row, and the cycle will most likely continue until you can get yourself in the right frame of mind. That is why I'm going to suggest you try something new. I think it may help you a lot. After your next losing trade, here's what you should do. Paper trade. That's right, have your next trade be a paper trade. Do the trade as you normally would. The next opportunity that comes up, don't really do the trade, just do it on paper. But you must make it as real as possible. Write it down like you would a normal trade. Even pick up the phone and pretend to put the order in with your broker. Then follow the trade as you normally would. Remember to put your stop order in and, hypothetically, trail your stop order if the market does move in your direction. If you're going to do this, it's important that you take it seriously. If you're just going to look at the market and say I would have done this or that, you're just wasting your time. If you're going to do this, it's important that you take it seriously. If you're just going to look at the market and say I would have done this or that, you're just wasting your time. It must be real, whether it takes 5 minutes and then you get out of the paper trade, or it takes 2 hours. as you continue to trail your hypothetical stop as the market moves in your direction. You must take it seriously for it to help you. Chapter 15. Revenue Trading. Revenge trading comes from one thing and one thing only: blaming the market for your loss. But let's think about this realistically. Who is to blame when you have a loss? Actually, I think blame is the wrong word. The question should be, who is responsible when you have a loss? Of course, the correct answer is you. The market didn't cause you to have a loss. So, getting mad at the market and trying to seek revenge really doesn't make a whole lot of sense. And if you are responsible for your actions, then when you seek revenge for the loss you received, you are actually trying to get revenge against yourself. And that definitely doesn't make any sense. Why would you want to seek revenge against yourself? But that is exactly what you are doing when you get mad at the market and try to get your losses back in almost a vengeful way. If you are frustrated and angry, you are just going to make trading mistakes that will most likely even cost you more money. Many people are confused at why revenge even comes into play during trading. But it's really very simple. Think about gambling, for example. You can only lose what you decide to bet. When you bet the money, it's easy to take responsibility for your losses because most likely you had to actually physically place the bet on the table, and you can only lose what you decided to risk. But obviously, in trading, it's much different. If you don't or can't get out of a losing trade, you can lose much more than what you originally planned to lose. Even with stop orders. In the futures markets, there can be slippage involved that will cause you to lose more than what you planned. Then it's easy to blame the market for those losses. The markets took your money. This is definitely where the revenge factor comes into play. Let's look at an example. Let's say you lose 300 points in the last trade. Will 100 points profit be enough in the next trade? The market may be clearly telling an objective observer that's all there is in this trade, 100 points. But to the person who just lost 300 points, especially if they intended to risk less than 300 points, many times 100 points won't be enough because you're not getting back everything you lost. You will need a lot closer to 300 points to feel right again. But let's think about this realistically. Does one trade really have anything to do with the other? The market doesn't know or care how much you made or lost in the previous trade. It has no bearing whatsoever on your next trade or your next 50 trades. That is one thing you always need to keep in mind at all times. One trade has nothing to do with the next trade. They are not related in any way. So, attempting to get back in one trade what you lost in the last trade doesn't make any sense. You can only profit from what is available in the current trade. And again, it has nothing to do with the trade you were just in. When you feel compelled to get back what you just lost, you try and take on the market, almost as if to challenge it to a fight. That is certainly the wrong attitude. You want to flow with the market, not fight it. You can't fight it because you can't win that way. You can't change what the market will do. You can only change yourself. Mark Douglas states it very clearly. The market can't take anything away from you that you don't allow. If you lost money or lost more than you intended to risk, you gave your money to other traders. Ultimately, however, revenge creates an adversary relationship with yourself. If you're the one who gives your money to the market, you are also the one who gives yourself money out of the market. If you are angry with yourself for letting the last trade get so out of hand, whatever the market is offering you now, in terms of an opportunity, won't be enough. From a psychological perspective, you won't take the opportunity for a profit or otherwise because you haven't accepted the last trade as being all right. In effect, you will be denying yourself the current or next opportunity to punish yourself for the past mistake. In reality, you can't get back at the market, and a belief in revenge only allows you to get back at Yourself. I think it's probably obvious to most people that trying to take revenge on the market is bad. But I hope you now realize that when you are trying to get revenge on the market, you are really only taking revenge on yourself. Chapter 16. Wishing, Hoping, and Praying. Remember earlier we talked about how important it is to be an active winner and loser. In other words, you must act to take profits and act to get out of losing trades. You cannot be passive with the market, and that's exactly what wishing, hoping, and praying does. It makes us passive. In general, there is nothing wrong with wishing, hoping, and praying. We all hope and wish certain things will happen in our lives, and that's fine. But there is no room for it in trading. The problem comes when we wish, hope, and pray that the market will do what we want it to. This puts us in a passive relationship with the market. Thus, we don't become an active winner and loser. When you wish, hope, and pray that the market will do a certain thing or move in a certain direction, you are shifting the responsibility to the markets. But as you already know, the responsibility should not be with the market, but within ourselves. In other words, only we are responsible for the results we receive. Hoping, wishing, and praying that the market will do what we want is very harmful. Many times it paralyzes us and prevents us from doing what's in our best interest. This happens because what the market is doing doesn't agree with what we want it to do. And many times our wishing, hoping, and praying causes us to be locked into our opinion of the market. The one thing you must remember is that our opinion isn't necessarily right about the market. To make it even more difficult, our opinion could be right, but we just might be too early. But that's okay. You don't have to be right all the time to be successful. You just can't get so locked into an opinion that you are wishing and hoping the market moves a certain direction. The market will only move in whatever direction the buy and sell orders cause it to move. Unfortunately, your wishing and hoping will have no bearing on which direction the market moves. If you find yourself wishing, hoping, and praying the market will do something, this is an excellent indication that you do not have a good grasp of the current situation, and it's definitely time to exit the position and reevaluate. It's very easy to get in the habit of wishing, hoping, and praying, especially for newer traders, but as you can see, it's a big mistake. Obviously, you'll want to avoid it at all costs, because it will never be acting in your own best interest, and it will always be difficult to succeed in that passive relationship. The one thing that makes all of this a little confusing is that intuition, that little voice in your head that tells you what to do, feels very much like wishing, hoping, and praying. In The Disciplined Trader, Mark Douglas explains it very clearly. However, there is another less obvious problem with avoidance, especially with respect to wishing and hoping. A true intuitive impulse, a deeper level of knowledge and wisdom that will indicate the next most appropriate step to take, that will always be in our best interest, feels very much like wishing and hoping. In other words, it is very difficult to distinguish between the two, making it very easy to mix them up, which is one of the reasons why we find it so difficult to trust our intuition. The way you can know for sure that you are getting a true intuitive impulse is to clear out of your mental environment anything that would cause you to wish and hope that something will happen instead of confronting the issue head on to find out what needs to be done. You can wish and hope that the market will come back, or you can cut your loss and make yourself ready to take the next opportunity. Requires that you change anything in your mental environment that would cause you to avoid confrontation and consequently wish and hope. The less cause you have for wishing and hoping that something will happen, the more you will know that when you get that certain feeling, it is a true intuitive impulse, and the more confidence you will have to follow it. Intuition will always guide you in the most appropriate way to fulfill your needs. You can wish and hope that the market will come back, or you can cut your loss and make yourself ready to take the next opportunity. Chapter 17. doubling up, adding to a losing position. As we've talked about so far, the most important thing you can do is keep your wrist to an absolute. Chapter 19. Fear. Many times we can sabotage our own trading because of our fears. In many cases, fear is good and helpful in our lives. But in trading, it can really be harmful. Fear helps us avoid things in the environment that we perceive as threatening. It's important to note that what we perceive as threatening may not necessarily be threatening. We just perceive it as threatening. And as far as our minds are concerned, it is a real threat. A good example is offered in The Disciplined Trader. A child severely bitten by a dog will quite naturally associate all dogs with the threat of pain and consequently generate an intense fear or even terror whenever he encounters any dog in the future. The child's fear of all other dogs other than the one that bit him is real. He has no way of making a distinction between a friendly and a dangerous dog because his personal experience leads him to believe that all dogs are dangerous. That is his truth about the nature of the environment. However, his truth is not all the environment has to offer in the way of experiences in relationship to dogs. Not every dog that exists is dangerous. Quite the contrary, very few would be considered threatening. Most see a child and want to play. Now, in every chance encounter the child has with a dog in the future, he will create an experience of terror, regardless of the disposition of any particular dog he happens to run into. If a dog makes any movement toward the child will perceive that movement as an actual attack when all the dog wanted to do was play or be petted. In fact, the child could become so afraid of being attacked that he will devote most, if not all, of his attention to scanning the surrounding environment for dogs. Eventually, his senses will become attuned to picking up their sights and sounds, and every time he sees or hears one, he will create another terrifying experience that just reinforces his fears. His focus of attention will attract to his attention the object of his fears, so that he can avoid what he has learned is threatening. The problem is that what he has learned is erroneous in relationship to the conditions that not all dogs are dangerous. Not knowing that, he will naturally believe that his terror is coming from outside instead of inside him. In effect, his fears are acting on his perception to create the very experiences he is trying to avoid by causing him to hone in on all the dogs in the environment. Do you see how the fear of the young child could be similar to the fear that we could experience during trading? When we focus on our losing trades, mistakes, etc., we give our subconscious mind powerful directions. We could then easily end up with those same losses that we are trying so hard to avoid. What we focus our attention on is usually what we get. It's not necessarily as easy as focusing our attention on winning trades and proper trading mechanics to get us to be successful. But it's not that far off either. You see, if you do continually focus intensely on your mistakes and poor trading decisions, you are more likely to end up with more of the same. Your subconscious sees the mental pictures you are giving it and acts out on the directions that it is receiving from you. That is how the subconscious works. It takes the mental pictures that you give it, like worrying about getting bit by a dog or worrying about trading mistakes you've made in the past, and does its very best to act out these directions on your behalf. As you'll learn in Section 3, your subconscious does not care if you are giving it directions that are not in your best interest. It simply attempts to follow the information it is given regardless of whether or not is really helpful or not. Just like in the dog biting example, the child sent directions to his subconscious that all dogs are threatening to him. Two things are important here. The first one is that the information is not necessarily true. Obviously, not all dogs are threatening. In fact, most are fun to play with and would be very enjoyable for the child. And the second important thing is that this information is not helpful to the child. Obviously, the Child would be happier if he were able to have a friendly relationship with most dogs than to be afraid, but nevertheless, as far as the child is concerned, the information that all dogs are threatening is very real and true. There are still other ways our fears cause us problems in our trading. Remember, our fears act as a warning mechanism to help us avoid what we believe to be threatening. One way many people do this is to avoid information that would be threatening or against our current opinion. Instead of clearly seeing all the different pieces of information that would help us make good trading decisions, we do just the opposite. We ignore important pieces of information that would be threatening to us. When trading, this can be very, very dangerous, and it will never help us act in our own best interest. When we trade with fear, we can easily block things out. For instance, if we are in a trade and the market is offering us information that would indicate we are right or information that would indicate we are wrong, what information do you think we will focus on? We obviously put a lot of weight in the information that will make us right and many times ignore the information that is telling us of other possibilities. This kind of thinking can be very dangerous for any trader because, after a while, the threatening information can become so overwhelming that you can simply not ignore it any longer. The only way to relieve the stress and anxiety will be to get out of the trade. A winning trade will be handled in the opposite way by a fearful trader. His fear of losing will cause him to focus on what the market can take away from him in his current winning trade. Remember, in a losing trade, the fearful trader will focus on only the information that supports his current position and ignore other factors that may not agree with his opinion. But in a winning trade, the fearful trader will do the opposite. He will ignore any information that states the market has potential to continue in a profitable direction. He will be so focused on information that will confirm his fears of the market taking the profits away that he will exit the trade early regardless of the profit potential left in the trade. And it gets even worse if the market does go his way after he exits the trade. He finds it very easy to agonize over why he couldn't stay in the trade a little longer. He certainly doesn't realize that it was his fear of losing that caused him to get out of the trade and leave that money on the table. These are the main reasons why most traders cut their profits short and let their losses run. In a winning trade, a fearful trader will focus his attention on information that the market is going to take his profits away. And in a losing trade, a fearful trader will focus his attention on anything other than what would indicate this trade is a loser. Obviously, this fear will sabotage your trading because it causes you not to act in your own best interest. To prevent it, we must learn to trade without fear. To trade without fear, we need to completely trust ourselves to know we will always act in our own best interest. So to be successful, you need to focus on different things than the majority of traders do. Letting your losses run and cutting your profits is what most people do. You need to do the opposite, and to do it you need to change your thinking. In Section 3, we will learn to do just that. Section 3. How to improve yourself. Chapter 20. What is Psycho-Cybernetics? And how can it help your trading and your life? Introduction. From Zero Resistance, Living by the Psycho-Cybernetics Foundation, Inc. A science can be defined as a tested, proven system of knowledge that can be used to produce predictable, accurate results. The science of navigation allows us to calculate exactly where we are anywhere on Earth or in space, and to accurately predict where our destination is and when we will arrive at it. The science of chemistry makes possible new compounds and products that enhance our health, nutrition, safety, every area of our lives. With a single bone, the science of archaeology can reconstruct the world and life of an animal that died millions and millions of years ago. The sciences of aeronautics and computers make it possible to maneuver an unmanned spacecraft millions of miles away with pinpoint accuracy and to broadcast a detailed photographic record of its journey. So a science can be thought of as a system of information so dependable and true that it can be used to make life better. Psycho-Cybernetics is the first science of human development. Chapter 21. Some background to get you started. I really feel for you to learn and really understand an idea or a set of ideas. It's important for you to know the background of where it comes from. If you understand where the ideas come from and the foundation of where they came from, it makes understanding the details much easier as well as making them being more meaningful. Dr. Maxwell Maltz wrote a book called Psycho-Cybernetics, and it was first published in 1960. This book became a huge bestseller. It is often thought of as one of the best self-help books ever written. Dr. Maltz was one of the world's most widely known and highly regarded plastic surgeons. He was a professor of plastic surgery at the University of Nicaragua and the University of El Salvador. Even today, Dr. Maltz's discoveries in the field of self-image psychology continue to influence thousands of people worldwide. Psycho-Cybernetics is still on the cutting edge of personal development technology. It remains as timely today as the personal computer. In fact, Psycho-Cybernetics has often been called the first and only true science of personal development, and many experts feel it is the only true way to alter your personality. As a plastic surgeon, Dr. Maltz operated on thousands of people. The plastic surgery that he performed on people, usually facial surgery, brought not only a change in these people's physical appearance, but in many cases, an amazing change often occurred in their personality. 2. This dramatic change in personality occurred almost immediately after their face had been changed. Dr. Maltz realized when you change a man's face, you frequently change a man's psyche too. Dr. Maltz realized this was an awesome responsibility, so he knew he needed to learn as much about this phenomenon as possible. He figured he owed it to his patients and himself to know fully about what he is doing and the dramatic changes that he was bringing about in people's lives. The strange thing was that some patients showed no personality change whatsoever to the dramatic changes in appearance, while on the other hand, many other patients showed huge changes in attitude and personality less than a month after surgery. Dr. Maltz needed to find out why some people changed for the better and others simply acted as if there was no change at all, as if the surgery was not performed. This told Dr. Maltz that the changes in appearance were not the key to the changes in personality. There was something else, which was usually influenced by the facial surgery, but sometimes not. When this something else was reconstructed, the person himself changed. When this something else was not reconstructed, the person himself remained the same. Although the physical features might be radically different, it was as if personality itself had a face. This non-physical face of personality seemed to be the real key to personality change. If it remained scarred, distorted, ugly, or inferior, the person himself acted out this role in his behavior regardless of the changes in physical appearance. If this face of personality could be reconstructed, if old emotional scars could be removed, then the person himself changed, even without facial plastic surgery. Once he began to explore this area, he found more and more phenomena, which confirmed the fact that the self-image, the individual's mental picture of himself, was the real key to personality and behavior. The picture you have of yourself will also determine whether or not you can be successful in trading. In other words, if you have a clear picture of yourself as a successful trader, that will go much farther than you can imagine in getting you to become and remain a successful, profitable trader. You will need to learn how to see that picture clearly in your mind. It is the only way to achieve success. Chapter 22. Mental Pictures. Successful men and women have, since the beginning of time, used mental pictures and Rehearsal practice to achieve success. Napoleon, for example, practiced soldiering in his imagination for many years before he ever actually went on the battlefield. He vividly imagined himself as commander and drew up maps showing where he would place various defenses. He would make all his calculations with mathematical precision in his mind. Conrad Hilton, the famous owner of the Hilton hotel chain, saw himself owning and operating hotels in his imagination many years before he bought his first hotel. Mr. Hilton said he imagined himself to be a successful hotel man long before he became one. A famous basketball coach once said, "There is no way to put the ball in the basket when the pressure is on if you can't see the ball going in the hoop clearly in your imagination first." I would say the same is true for trading. If you can't clearly see yourself in your imagination as a successful trader, there is no way you can be a successful trader. The best, most successful traders have been vividly picturing themselves as successful for many years. And in many cases, these traders pictured themselves as a success long before they actually were successful. There is an automatic mechanism inside all of us. Dr. Maltz calls it the servo mechanism. And it is an automatic goal-seeking machine which steers its way to a target or goal. We all have this inside of us and can use it to achieve goals that we want to reach. This servo mechanism works very much like a guided missile. But just like a guided missile, it needs proper programming to hit its target. That programming comes in the form of mental pictures that we give the servo mechanism. If we continually give the servo mechanism clear, vivid pictures of the goals we are trying to achieve, our subconscious will quite automatically do the necessary things to help us achieve our goals. On the other hand, if we continually think and picture the things we don't want to happen, our servo mechanism will take those pictures as our goal and attempt to make those bad pictures come true. You see, the servo mechanism works quite automatically. It simply takes the mental pictures we give it and tries to make them reality. It doesn't care if those mental pictures are in our best interest or not. It simply reacts to the mental pictures we give it. For example, if we are worried about being able to give a speech in front of a large number of people, if we vividly picture in our minds the speech going very well and the audience receiving us in a positive way, this will go a long way in helping us to give the speech and have it come out the way we want. But on the other hand, if we continually worry that we will be laughed at, the words will come out all wrong, and we will give a poor speech. Then this is what will most likely happen to us. Our servo mechanism will most likely perform the type of speech we have vividly pictured in our minds. This is precisely how the success and failure mechanisms inside us work. We will talk about the success and failure mechanisms a little more in a few minutes. But the goal or picture in your mind must be within your capabilities. For example, in trading, if you picture yourself making a few $100s a day or a week, then you can probably achieve that goal as long as you can see it in your imagination clearly enough. On the other hand, if you picture yourself making $5,000 every day, no matter how clearly you picture that goal, it will be next to impossible to make it reality because it is probably not within your capabilities. You can imagine yourself any way you want in the future, success or failure. It's all up to you, but all too often, people are not willing to exercise this control. They allow their imagination to destroy their potential by picturing situations in the past in which they have failed. We all carry mental scrapbooks, but instead of preserving the joyous occasions of life, the moments of accomplishments, some people save only their times of failure and frustration. But it's so easy to take control over their imagination. All you have to remember is that your brain has a hard time distinguishing between real and imagined experiences if they are vividly enough imagined. If we picture ourselves functioning in specific situations clearly and vividly, it is the same as the actual performance. Mental practice can help you perform better in real life. You will learn specific mental exercises to help you improve your trading. These mental exercises, if imagined this otherwise, we could not correct our course and steering or guidance would be impossible. But it is futile and fatal to hate or condemn ourselves for our mistakes. One of the biggest reasons people get into losing streaks while trading is because they confuse their losing trades with themselves. In other words, we conclude that because we had a losing trade or a series of losing trades, we are a losing trader. But the important thing to remember here is we are not our losing trades. Losing trades are part of trading. There isn't a single trader in the world who doesn't have losing trades. The only way to avoid them is not to trade in the first place. You cannot be a successful trader until you take mistakes and losing trades for what they really are. They are simply byproducts in the trading game and need to be used to gain learning and understanding. But in no way do they define us as a person. But that is where the big problem comes in. Many people let their losing trades and mistakes define them. If they're having trouble and have had a series of losing trades, they start to think of themselves as a loser. They continually think of themselves in that way. As we know from before, this kind of thinking will just bring on more of the same. Forgiving yourself completely is the only way to avoid this trouble. You are not your mistakes and losing trades. You must put the past behind you and go forward. Holding a grudge against yourself only hurts yourself. Forgive yourself. It's the only way to be successful. Chapter 25. Famous people use Psycho-Cybernetics. And for good reason. Visualization techniques and mental practice have been working for professional athletes for years. Dennis Rodman, known to many as the best rebounder in the National Basketball Association, has said that he uses visualization to prepare for each and every upcoming game. Before the game starts, Rodman spends a solid hour right before each game by himself. Everyone on the Chicago Bulls knows he is not to be disturbed. He vividly rehearses in his mind exactly what he will do in the game and how he will react to his opponent based on things he's seen in past games. He clearly sees the game unfolding in his mind. He sees himself confidently pulling down rebounds and making accurate passes to his teammates. He sees all this using as many details as he can. You see, the details are very important. With visualization techniques, the clearer you see the picture in your mind, the better your subconscious success mechanism will work to get you to your goal. But remember, the details are extremely important. The reason is your mind cannot tell the difference between an imagined experience and a real experience as long as there is enough vivid detail. For example, Dennis Rodman, when visualizing the upcoming game, will not only picture himself getting rebounds and diving for loose balls on the court, but for it to be really effective, he must feel the pressure of his feet hitting the court after getting that rebound. He must feel the opponent pushing him in the back as he fights for a loose ball. He must see the shine of the powerful lights reflecting on the court. He must visually feel the leather surface of the ball as he's holding it. These details are extremely important for Dennis Rodman or anyone using visualization techniques to see and feel. Dave Stockton, the famous golfer, says much of his success has come from his reading and using Psycho-Cybernetics. Stockton was always a good golfer, but in 1970, for some unknown reason, his putting was terrible and getting worse with each tournament he played in. He hadn't finished in first place in over 2 years. His father gave him the book Psycho-Cybernetics by Dr. Maxwell Maltz. His father, a former golf professional and the only teacher Dave Stockton ever had, said he didn't think the putting problems were physical, rather, they were mental. Stockton didn't read the book until a week before the PGA Tour Championship, which is one of the biggest tournaments of the year. But when he did read it, He certainly got the message. He learned to use his past successes to visualize the way he would play at the tournament. He spent that week visualizing with incredible detail how he would approach each putt, and he would see in his mind all the tough putts he'd made in the past. And that is exactly how Stockton went into the tournament. From the very first shot, he had the confidence that the visualizing and mental practice had given him. As far as he was concerned, he had already won the tournament in his mind. To really put him to the test, on the last day of the tournament, he was paired with arguably the greatest golfer of all time, Arnold Palmer. A pairing that would make any golfer nervous and could cause anyone to lose his concentration. But not Stockton. He credits Psycho-Cybernetics with helping him keep his concentration and thus winning the PGA Championship. And $40,000, a lot of money in 1970. Not bad for a book his father bought for 95 cents. When asked if all the golfers in the PGA began to use Psycho-Cybernetics, how would it affect the various tournaments? Stockton replied, the game might just become one big hole-in one. Former NFL player Jim Clack says, Psycho-Cybernetics made all the difference for me. I went from a free agent to the Super Bowl with it. I use the ideas today as a business and corporate sales trainer. Maxwell Maltz literally transformed my life. Psycho-Cybernetics, new in Thing with Packers, August 5, 1967. Fort Lauderdale paper. Chicago, the big thing with the Green Bay Packers now is Psycho-Cybernetics. That's like the power of positive thinking, only the name is fancier. Maxwell Maltz wrote the book on Psycho-Cybernetics. Not many people ever heard of Maxwell, but they know his readers. Bart Starr is one of them, and so is Zeke Bradkowski, both Green Bay quarterbacks. Even coach Vince Lombardi reads what Maxwell has to say. Don Chandler, the Packer punter, had the book opened in his room Friday afternoon, alternately making his thinking more positive and freezing his mind by watching a soap opera on television. He had borrowed the book from his roommate Jerry Kramer, a Packer for 10 years. It just makes you know what you can do, what you have inside yourself, said Chandler, wrapped in a sheet as if he were about to address the Roman Senate. It has really caught on with the team this year. Power of pen propels Dillard. Toronto Daily Star, November 20th, 1968 by Jim Proudfoot. A fortnight ago, Jim Dillard was in the worst slump of his football career and had begun to think there was no way out. Then he was introduced to Psycho-Cybernetics, the philosophy of a man called Maxwell Maltz. Dillard was sold on the idea immediately, started to study a book on the subject, and in the 2 games he's played for the Argonauts since then has averaged 7.9 yards each time he's carried the ball from scrimmage. The improvements have been dramatic, to say the least, because during the 14-game Eastern Conference schedule, his average output was a meager 4.6 yards. Moreover, he was sluggish and out of tune with his fired-up colleagues. Now, since the playoffs began, he's been blocking and running decisively, like the Dillard of bygone years. Before, he ran as if expecting to be stopped. Now he runs as though convinced he can't be stopped. Dillard's revitalization is an important reason the Argonauts now find themselves close to the Eastern Championship and entry to the Grey Cup final, owners of a 2-point lead over the Ottawa Roughriders in a playoff doubleheader, which is to be completed at Ottawa's Lansdowne Park Saturday. Maltz gets the credit. And should the Argonauts' extravagant dream really come true, then they'll owe a vote of thanks to this Maxwell Maltz. His book is responsible for the change in Dillard, who made 146 yards in the semifinal conquest of the Hamilton Tiger Cats, and another 100 last Sunday when the Argonauts got the jump on Ottawa. Consistent production by Dillard had been the missing ingredient in the Argonauts' offense all season, and the one thing they absolutely had to get in the playoffs. I got excited about Psycho-Cybernetics as soon as I read the first chapter. Dillard was saying yesterday. There are a lot of angles to it, but I think I can explain it in a simple way. It shows you how to emphasize your good points. You may be tempted to think this won't work or it's silly. All I can tell you is Michael Jordan, Dennis Rodman, Bart Starr, Ben Hogan, as well as many successful traders believe and have used it to improve their performance. If those people can be so successful from it, the least you can do is give it a try to see if it can be successful for you too. Children as young as 8 years old, as well as senior citizens, have all benefited from the use of Psycho-Cybernetics and the visualization techniques that go along with it. Professional athletes, salesmen, traders, and people in many other walks of life have successfully used it to improve their concentration and performance. There is no reason to think you can't do the same thing. We have a choice of either using our success mechanism by seeing positive, helpful pictures, or using our failure mechanism by seeing negative images of the past. The choice is up to us. If we start to trade with negative feelings, we will fail before we even start. On the other hand, if we start to trade with positive feelings, that will go a long way to us succeeding. Here are some rules to remember when using visualization techniques to improve your self-image. 1. You must be in a relaxed state when going into the theater of your mind. Michael Jordan is obviously in a relaxed state when he is working his magic on the basketball court. Without being in a relaxed state of mind, it's next to impossible to succeed. At the end of this chapter, we will have a relaxation technique that will get you in the right frame of mind to visualize your success. It also helps to be very comfortable, like being in your favorite chair without any distractions, no music, TV, etc. 2. You must pay close attention to the details of your mental pictures. Remember, in our mind's subconscious, we cannot tell the difference between an imagined experience and a real one if the details are vividly portrayed. This is not daydreaming. You must focus intensely on the details around you. The sights, sounds, smells, etc. are all very important for these exercises to benefit you in a positive way. 3. You must act as if you are already the kind of person you want to be. The real key to changing your self-image is to continually think of yourself as already being the kind of person you want to be. If you continually keep in your mind the picture of the way you want to be, for instance, a disciplined, consistent trader, then you need to continue to picture this in your mind, and, even more so, you need to keep acting like you are already that way. After not too long, your powerful subconscious will begin to follow suit. 4. You should go into the theater of your mind at least once a day, and preferably it should be the same time each day. Scientific experiments have shown it takes about 21 days to change a habit or a thought process. In the simplest terms, that's exactly what we are trying to do. We are trying to change a bad or unhelpful habit into a good and helpful one. But doing this takes time. You did not form your bad habits in one day, so it's impossible to expect them to change in one day. But if you consistently use these exercises for 21 days in a row, you will be pleasantly surprised at how your habits have changed. In fact, you can certainly use Psycho-Cybernetics to change more than just your trading. It can be used to change and improve almost any aspect of your life. Relaxation technique: calm body, calm mind. It is very beneficial to be physically and mentally relaxed before doing the visualization exercises. Here is a simple technique to use in the theater of your mind to bring on relaxation. 1. Sit down in a comfortable chair or lie on a bed. There should be no other distractions. Turn off the TV, radio, and the lights. Go into the theater of your mind. See yourself in a comfortable theater getting ready to watch a movie about you. 2. Again, remember to pay attention to details. What is your theater like? How does the seat feel? Is the screen big or small? Are you sitting in the middle row or at the aisle? Are there arm rests on the chair? How do they feel on your arms? The details are very important. 3. Lie down and imagine your body's a series of rubber balloons. There are 2 valves in your feet. They open and air escapes from your legs. Your legs collapse until they are empty and lie flat against the bed. A valve now opens in your chest and your whole body begins to collapse limply against the bed. Continue this exercise with the arms, the neck, and the head. You don't have to do this in bed. If you're in the office, try to fix a picture of yourself in your mind's eye of yourself lying in bed doing the exercise. You will actually feel the relief from being relaxed. Physical relaxation leads to mental relaxation. When practiced daily, it gives us that relaxed attitude which allows us to better control our actions. Each time you practice this technique, when your body and mind are feeling completely relaxed, be sure to say to yourself mentally, "Calm body, calm mind." This deepens the programming of your servo mechanism. As you practice this technique, you will find the time it takes you to become relaxed will be shorter and shorter. Eventually, you will be able to relax totally at any time and in any situation, simply by saying to yourself mentally, "Calm body, calm mind." Chapter 27. Goal Setting Exercise. I can't stress enough how important goal setting is to being successful in your trading. If you don't have daily, weekly, monthly, and yearly goals for your trading, it will be very difficult for you to visualize your success. This is because you will not have something specific to aim for. To be at our best, we always need a clear, measurable goal to strive for. Remember, man and woman are at their best when they have a clear goal securely in mind. This exercise will teach you how to visualize you reaching your set goal of making a certain amount of money each day. That does not mean you will reach that goal each and every day. But without having that clear set goal, you will probably not reach it most days. Exercise. Get in a relaxed state with a relaxation technique. Calm body, calm mind. 1. Go into the theater in your mind. Remember to make the theater as comfortable as possible. Have it be a nice, soft, comfy chair that you are sitting in. Remember, details are very important. Pay attention to them. Is the screen big or small? How do the arm rest on the chair feel? Details, details, details. At this point, you are trying to strengthen your imagination and see the pictures in your mind's eye extremely clearly. If you can't see the pictures clearly yet, don't worry, it gets easier with time and practice. 2. With this exercise, we are going to visualize ourselves at the end of the trading day, having reached our goal. Remember, it is very important that your goal be realistic and measurable. Having a measurable goal is easy, because an amount of money is always a measurable thing. But also remember your goal must be realistic. So, if we are a day trader and we visualize ourselves making $250 a day, that seems realistic. If we are a day trader and we try to visualize making $3,500 a day, that is probably not realistic. Because making that kind of money is probably beyond most people's capabilities on a daily basis. 3. The first thing we want to visualize or picture in our minds are days that we've been successful with our trading. We want to remember those days where we've been able to make our goal. For this exercise, we will use the daily goal of $250. If you need to go back and look at your trading statements to find days that you made money, then do that. The idea here is you want to see those days in your mind and feel the feelings you got from being successful on those days. Play those days back to yourself in your mind. Remember to notice the details in those days. How does the phone feel in your hand when you were placing the orders? Can you see yourself moving the mouse on the computer to check the charts? Can you see yourself writing your orders down on a piece of paper? How does the pen feel in your hand? Details, Details, details. 4. For those people that have not had winning days trading, or if you can't remember them, that's okay. Like we said earlier, you can simply make up an experience in your minds. When you were successful. See yourself getting out of your winning trades. Chapter 29. Statement Equity Increase. This is a visualization exercise I've been using for years. In my opinion, it is extremely effective. The idea here is to visualize the equity money in your account continually rising. This is a very simple exercise and should be done on a daily basis. Exercise 1. Get in a relaxed state with a relaxation technique. Calm body, calm mind. 2. You'll want to visualize how your trading statement looks in your mind's eye. The best way to do this is to actually look at your trading statement and then be able to see it in your mind's eye. 3. If you receive an actual hard copy, paper, statement, notice how the paper feels in your hand. See your name and account number at the top. See the brokerage company's name at the top. Notice the trades from the previous day on your statement. See all the details of your statement in your mind's eye. If you receive your trading statement through email, then picture it on your computer screen. It's important that you see your statement in the theater of your mind, exactly how you actually see it in real life. For now, I want you to take your daily goal. Let's say for this exercise our daily goal is to make $500 each day. We want to visualize our daily goal being added to the previous day's statement. So, for instance, let's say yesterday my account has $7,200 in it. Today, I want to visualize my account statement after making my goal of $500. So I will see in the theater of my mind my account having $7,700 in it today. 5. But that's not enough just to see the increase in equity. We must see more details for it to feel real to us. We need to see the trades that made us the $500. So while you're looking at your statement in your mind's eye, you must also see the trades that made you the $500, or whatever goal you have. 6. These trades can be made up or can be trades that you've had in the past. In fact, what will work best is if you have had actual days where you've made your goal. I would then use those days as your mental practice. Relive the feelings you had after the day where you made your goal and feel those winning feelings again. See yourself looking at your statement and feel the satisfying feeling of a profitable trading day. Remember to try and feel those winning feelings that you had when you've had good trading days. That feeling will be very important to reprogramming your success mechanism. 7. If you haven't had any winning days, that's okay. Just use a time in your life when you were successful at something and clearly remember that right before you change the scene to your trading statement. Then just make up the trades. Remember, your subconscious can't tell the difference between a real experience and a vividly imagined one. So it will be better if you can use a real experience, but a vividly imagined experience will work well too. This exercise is best done in the morning before the market opens. You need to see yourself reaching your goal as clearly as possible. After doing this for a while, it will help your powerful subconscious to reach your goal. Believe it or not, doing this exercise will help you avoid making trading mistakes because your mind will be clearly focused on your goal. Thus, if you are about to make a trading mistake, your subconscious, if properly trained, will override your thought process and help you avoid the mistake in the first place. But this will only work if you practice it enough and can clearly see the pictures in your mind's eye. It won't happen overnight, but it will happen with daily practice. Chapter 30. Pulling the Trigger Exercise. The reason people can't pull the trigger when they sense an opportunity happens for one reason and one reason only. They are afraid. But they are not afraid of the market, they are afraid of themselves. Their fear comes from not having complete trust in themselves to act in their own best interest. You fear your inability to do what you need to do, when you need to do it without hesitation. Being afraid causes us to freeze up and makes us unable to pull the trigger to execute our trades. This causes missed opportunities. But the end result of these missed opportunities is the real problem of not being able to pull the trigger. After we miss an opportunity, because we are afraid, we play the scenario in our minds in a very unrealistic way. For example, let's say we wanted to get long the market. The opportunity comes up for us to get in the market, but our fear prevents us from pulling the trigger, so we do nothing. Then, the worst possible thing happens in our minds. The market then rallies, and we start counting the money that we are missing out on because we didn't pull the trigger. If the market moves our way 500 points, we think that we should have had that 500 points. We do this whether it is realistic or not. This is the failure mechanism hard at work. This kind of thinking is very harmful to our trading in the future. We mentally beat ourselves up for missing the trade, and we feel like we lost the money that we would have made if we gotten in on the trade. We get mad at ourselves. We call ourselves stupid or an idiot. We play the trade over and over in our minds thinking about the things we did wrong. This is just like the visualizing techniques we've been talking about. The only difference here is you are visualizing yourself doing the wrong thing. By continually thinking of yourself as a person who can't pull the trigger, you are reinforcing the idea in your subconscious. All of this is very destructive and makes things much worse. So we need an exercise to help us pull the trigger when we see a trading opportunity. We need to get past the fear that is causing us to freeze up and not to pull the trigger. And we definitely want to avoid visualizing or continually thinking about the mistakes we've made and the opportunities we've missed. We can't change the past, only the future. Exercise 1. Get in a relaxed state with a relaxation technique. Calm body, calm mind. 2. In this exercise, we want to visualize ourselves being able to pull the trigger without hesitation when we see an opportunity or when it's time to get out of a trade. 3. Go into the theater of your mind and first playback, with detail, times when you pulled the trigger as soon as you've seen a trading opportunity. Remember to see the details. See yourself watching the charts and seeing the opportunity. You see the green light go off in your head, and you don't hesitate. You pick up the phone, hit the speed dial button, and place your order. Can you feel how the phone feels in your hand? Notice how you feel sitting in your chair watching the screen. 4. See the trade going your way. Feel the feelings you have had when you've seen an opportunity and jumped on it. Feel how you felt when you did not hesitate and were able to pull the trigger without hesitation. 5. If you haven't had trades where you were comfortable pulling the trigger, then try this. Remember a time when you did something and you were comfortable with it when it's hard for others. For instance, maybe you are a good negotiator and you're not afraid to ask for a lower price when others wouldn't be confident. Remember that time vividly and feel those confident feelings. Or maybe you are a person who is good at fixing things and wouldn't hesitate tackling a big fix-it job. You would obviously feel very confident that you could get the job done correctly. Then switch the scene in your mind's eye back to the trading situation and see yourself pulling the trigger at the right time. It's okay to make up the situation as long as you have the confident feeling first and you are seeing the pictures in your mind vividly with detail. You must get those confident feelings first. 6. Also see yourself liquidating this trade when you feel the time is right. See the details clearly. See yourself clearly calling up and getting out of the trade. Or if you trade through your computer, see yourself hitting the correct keys to liquidate the trade. Feel the confident feelings you get from having a successful trade. 7. Again, it's important that you do these exercises on a daily basis. They will not work after just one day. You didn't become afraid to pull the trigger in just one day, so you Can't expect to fix that problem in just one day either. Also, these exercises work better if you do them at the same time each day. 8. This mental practice will reprogram your self-image. After several weeks of practice, if you feel the confident feelings, your inability to pull the trigger will be a thing of the past. Chapter 32. Clearing the calculator. This exercise is based on what's called a high-voltage image. A high-voltage image is a mental picture, symbol, or quick mental movie that is vivid, memorable, and can have substantial impact on our thought process. High-voltage images are pictures we see in our mind that everyone is familiar with and can relate to. This is a little different than the mental movies we've been talking about. Everyone is familiar with what a calculator looks and feels like. In this case, we are going to use the clearing the calculator exercise to help us forget about our past trade and move confidently on to the next trade. A problem many people have is forgetting about their previous trades. For instance, if someone has a losing trade, they take the results of that losing trade and it influences how they act in the next trade. But as I hope you know, one trade has nothing to do with the next. The market certainly does not take into account how you traded in your previous trade. Even though most people realize this, they still let their previous trade influence what they will do next. For example, if you've just lost $500 on your last trade, does that have anything to do with how much potential the market has to move on your next trade? No, of course not. But many people will not be satisfied until they've made that $500 back. They don't consider that the market may not be offering $500 in the next trade, but because they can't forget about the last trade, they aren't satisfied with less than $500. This kind of attitude makes for some very bad trading decisions. So we need an exercise to help us forget the past trades, no matter what happened, and move confidently on to the next trade. This high-voltage exercise will help you to move on to your next trade without allowing your last trade to influence you negatively. Exercise 1. Get in a relaxed state with a relaxation technique. Calm body, calm mind. 2. Picture in your mind's eye a giant handheld calculator. Feel the calculator in your hand. See the screen and the various buttons on the calculator. Imagine that you see the buying and selling price as well as the result of your last trade on the screen of calculator. 3. Now we need to forget that trade. No matter if it was a winner, loser, or a break-even trade, we still need to forget that trade and move on to the next one. No matter what happened, we can't change the past. We can only keep our mind clear to be productive in the future. This is what clearing the calculator will do for you. For now that you see your trade on the screen on our calculator, we will need to clear the calculator. See yourself in your mind's eye with your big finger pushing the clear button on the calculator. Take in a deep breath while pushing the clear button down. As your finger lifts up off the button, let out that deep breath and expel all your tensions out as you clear the screen on your calculator. By pushing the clear button, you are getting rid of this trade forever. You cannot change it. You can only move forward and forget about it. 5. Now you see the calculator screen completely blank after you've pushed the clear button. The decisions you've made on the previous trade are gone forever. Take a moment to feel how much more relaxed you are. 6. Only now are you mentally ready to look for the next trading opportunity. Now that the calculator is cleared, the next trade that you do can stand on its own. In other words, the next trade has nothing to do with how the previous one worked out. And since the calculator screen is now blank, the previous trade will have no influence on the next one. 7. This exercise may be a bit cumbersome at first, but with practice, it will become easier and easier. After a short while, you'll be able to use the clear the calculator exercise in a matter of a few seconds. Chapter 33. Make your own visualization exercises. Now you've seen a number of visualization exercises you can use to help improve your trading. You've seen how visualization exercises work and how using either real or imagined experiences can benefit you tremendously. You've seen how using as much detail as possible can make the visualizing techniques even more powerful. You've gotten some ideas on how to go into the theater of your mind and change your bad habits into good habits. You've seen how getting into a relaxed state is so important before using the visualization exercises. With practice, you can now see the mental images clearly in your mind's eye. Now it is time for you to come up with some of your own visualization exercises. Now that you have the proper tools, it should be easy for you to come up with some exercises that will help your trading. You simply need to find out what parts of your trading you are having trouble with, or in other words, what are some of your bad trading habits. Once you've done that, simply build some visualization techniques to break those bad habits. Here are some things to remember when making your own visualization exercises. 1. You must be relaxed when doing visualization techniques. Trying to do these exercises with a stressed or tense attitude will simply not work. 2. Use as much detail as possible. Always use your senses to help you visualize. Can you see, feel, smell, hear all the things in your visualization clearly? If you can't, you need to continue practicing until you do. Remember, as adults, we've most likely stopped using our imagination like when we were kids. We need to strengthen our imagination as if we were trying to get physically fit. It takes practice, exercise, and time to get good. 3. When you first start with visualization exercises, try to do them at the same time each day. This will reinforce the habit. 4. Remember to build a theater of your mind in which you will watch the visualization process. Dr. Maltz has found that using a theater, something everyone is familiar with, has much better results in helping people see the images clearly. 5. Remember your past success to give yourself that winning feeling before and after visualizing. This will help give you the confidence it takes to succeed in the future as you make that winning feeling a habit. 6. See yourself with kind eyes. In other words, do not beat yourself up for your mistakes. Instead, you should forgive yourself completely and move on. By continually reliving your mistakes, you are actually practicing the mistake so that it can happen again in the future. Forgive and forget your mistakes. Psycho-Cybernetic techniques can help you do much more than simply being a better trader. They can help you with relationships, athletic competition, confidence in sales, social activities, etc. The book Psycho-Cybernetics has helped hundreds of thousands of people improve their lives in many different ways. There is no reason it can't do the same for you. Here are some more visualization techniques. I remember when I first learned about using visualization techniques quite a few years ago. Whenever I would have a problem with my trading, I would build a visualization technique to help me get rid of that problem. The following are visualization methods that I've used in the past. I put these in here to show you how easy it is to make up your own techniques to help you with any trading problem you may be having. Trading too early in the morning. For a while, when I first started trading off the floor, I would put on a trade right after the open. I was so used to trading on the floor where I would do between 150 to 200 trades a day. That's actually a small number of trades for a floor trader. Because of this, I would want to trade immediately after the open, even if there wasn't the best opportunity. I just wanted to be involved because I was so used to trading first thing after the open. The problem was this was costing me a lot of money because I was usually having losing trades on the volatile openings in the S&P 500 futures. It would also put me in a negative frame of mind because many times my first trade of the day was a losing trade. So I made up this visualization technique to help me avoid trading until there was a clear opportunity. 1. Get in a relaxed state with the relaxation technique. Calm body, calm mind. 2. Watch yourself in the theater of your mind. You want to see yourself sitting at your computer screen right after the market opens. See yourself with as much detail as possible watching the market. See the clock right after the open. What does the computer screen look like?